Welcome everybody, welcome to our webinar on what's next for media M&A in 2026. And this is the latest in our series of Selling Your Business series. So it's great to see so many people joining this morning and still a few people logging on, which is brilliant. So for those of you who aren't so familiar with us, Kingston Smith is a leading audit, tax and advisory firm. We work with businesses across a whole range of sectors as well as not-for-profit and private client. We're also part of More Global, which is an international network with presence in over 100 countries. So we regularly sort of team up with our colleagues across the globe to support our clients on their sort of international growth aspirations. In our West End office, we've got 12 partners and over 125 people that work exclusively within the media, entertainment and marketing services sectors. And we have a media specialist corporate finance team. And so they specialise in looking at M&A, so in particular sell-side advisory, taking sellers through the whole sales process and quite often teaming up with our M&A tax team as well. They do a lot of financial due diligence, so sort of acting for a number of strategic trade buyers and private equity houses on their acquisitions. They do a lot around exit strategies and valuations, including advising people on what the structure of consideration might look like. And they also run an agency exit program, which helps businesses get into shape in that sort of 2-3 year period in that run up to a capital event. Recent transactions that the media M&A team and the M&A tax team have completed include the sale of CC Group to the Hoffman Agency, New Territory to Genient, the acquisitions of Wuxi, Precious Media and The Forge, and also the investment into Arcade Media, the Sidemen's exclusive management partner by Lumina Media. So today we're going to be looking at the media M&A market as we head closer into 2026 and discuss the latest trends and updates from the market. And we'll hear from a great panel and they're going to cover perspectives from acquirers, investors, lenders and agency owners and give you an update on what they're seeing in transactions. So I'm delighted to be joined by Adrian Talbot, CFO at Miroma Group, Frazer, Head of Media at Barclays Corporate Banking, and Indre, Investment Director at Sovereign Capital. And they'll be joined by my colleague from More Kingston Smith, Paul Winterflood, who is our media M&A partner. So moving to today's proceedings then, I'm going to hand over to George Hatswell, who is a director from our media corporate finance team, and he's going to give you an update on the latest M&A landscape. And just before I hand you over to George, just a quick couple of housekeeping things. The webinar is being recorded, so please do share with your peers and colleagues or anyone who couldn't make it today. And we're really keen to have a lively conversation. This webinar is for you, so please do ask questions. Please do put them in the Q&A function where I can keep track of them, and then I'll try and weave those questions into the panel as I ask the panel questions. And lastly, we're always really keen to hear feedback from everybody as to what they thought of the webinars and suggestions for future webinars. So please do fill out our little survey at the end. It's super quick. So I will hand over to you, George.
Thank you, Esther. Let me share my screen and then we can get going. There we go. So, hello everyone. This morning I'm going to give a quick update on what we've been seeing recently from a mergers and acquisitions point of view in the media sector, and also our outlook on what we expect to see happening over the next 12 months. Now, our tracker looks at all the deals with a UK presence, which have been made across marketing services, TV, film, entertainment, and the publishing sectors. So far, we've tracked 243 deals in the first 3 quarters of 2025, compared to 292 in the same period of 2024, 16% fewer deals. So we're still seeing a good amount of deals being done, but a slight reduction on previous years. If we look a little deeper into these numbers and just highlight the marketing services deals, we can see that actually marketing services has been pretty resilient in 2025, despite economic pressures, with 185 deals in the first 3 quarters. But what deals are being done and which capabilities are we seeing demand for from acquirers? This next chart highlights the top marketing services sectors in the year to date. For those of you who've joined the last couple of these webinars, it sees the same themes coming out. Performance and media buying agencies are currently top of acquirer target lists. We have recent experience in the space with Paul and the team selling the award-winning media buying agency Total Media to Media Plus, a subsidiary of Service Plan, last year. We're seeing demand for performance and media buying assets being driven by brands seeking return on investment numbers and measurable campaigns which are becoming social and digital only as advertising spends increasingly shift online. In July, London digital agency Brain Labs acquired Exverus Media, an LA-based full-service media agency with expertise across the whole media spectrum, from connected TV and programmatic to retail media and paid social. This continues Brain Labs' global expansion following the acquisition of Sparrow, Australia's largest digital independent agency, last year. PR has also been a hot sector recently with lots of activity. Much of this has been centered around regulated market activities with lots of money flowing through them, such as financial services or healthcare, where navigating legislation and getting communications right is particularly important and subject to strict codes of conduct. Examples are FGS Global, making their first acquisition since KKR bought out the business from WPP last year, with the acquisition of London-based Edmunds Elder in August, a digital-first integrated comms and campaigning agency who work with lots of FTSE 100 companies. In the healthcare space, global medical comms agency Medcomms Experts acquired UK-based NextGen Healthcare Communications, an agency working with both healthcare professionals and patients. As well as performance, media buying and PR, we've seen a large number of deals involving creative, data analytics and experiential agencies too. Generation Media acquired Portal Studio in August, a creative agency in London working on campaigns across digital, social and video in the gaming industry. And PE-backed global experiential agency Impact XM acquired Shelton Fleming, a London-based experiential agency known for its immersive storytelling, digital innovation and creative delivery. Now, if we look into the TV, film and entertainment space, we can see that most of the volatility in our overall numbers are shown here. There's been a lot of activity in the last few years, but 2025 has seen a drop-off, particularly this quarter. However, there have been a number of interesting deals done recently. On the right, you can see that TV and film is typically the most active of the subsectors and accounts for 35% of the deals so far in 2025. ITV Studios have been busy this year with a couple of acquisitions, including Moonage Pictures in April, a scripted drama production company based in London, and Spanish scripted production company Plano a Plano in July. Then Channel 4 took its first ever majority stake in a production company a couple of weeks ago when it used its creative investment fund to acquire the Scottish factual production company Firecrest Films. It's been a tough time for TV production companies getting work commissioned recently, but those who are producing top quality content and have IP ownership are still seeing strong financial performance and deals being made. IP is particularly relevant for the creator economy, an area where we expect to see a lot of deals in the future as linear TV advertising budgets move over to YouTube. In 2024, YouTube overtook ITV to become the second most watched service in the UK, only behind the BBC. Deal-wise, in September, Arcade Media, a talent management group representing some of the UK's top content creators, including the collective of British YouTubers, the Sidemen, who have 24 million subscribers, received a significant investment from Lumina Media, with the deal helping to fuel Arcade's ambition to become the leading creator-first platform and building lasting IP that drives conversation and culture. And as Esther mentioned, that was a deal that Moore Kingston Smith provided the financial diligence services on. Then, in a deal announced yesterday, so not included in our Q3 numbers, Global Media and Entertainment launched Global Studios in tandem with the acquisition of the Fellas Studio, creators of some of the most talked about Gen Z shows in the UK, reaching millions across YouTube, Spotify, Apple Podcasts and social platforms. and we expect to see a lot more deals done in the creator economy space in the near future. So looking forward, what can we expect in the next 12 months? Firstly, looking at the hot sectors, if you have a business that ticks any of these boxes, please do get in touch, as we'd be keen to have a conversation and are speaking to acquirers regularly who are seeking these capabilities. I've touched on quite a few of them already: performance and media buying, regulated market PR agencies, and the creator economy. But looking at the right-hand side of the slide, sport. In the world of photorealistic AI video, sport is becoming increasingly relevant as something that is live, tangible, and scarce. Viewership is growing, audiences are engaged, and brands are continuing to up their spending in the space. Whether it's sports production companies or sports marketing agencies, demand for the sector is strong and capabilities are highly sought after. Experiential has become an increasingly attractive area for acquirers following the rebound of events and in-person experiences. Much of the growth in this space has been driven by brands reassessing their allocation of budget within the marketing mix. Many brands that adopted a digital-first approach during COVID are now recognizing the value of in-person experiences in building brand loyalty and capturing a greater share of budgets. Agencies in the space are seeing strong demand for their services and subsequently good financial performance. Finally, social. As I mentioned earlier, more and more spend is moving through online social channels and influencers. Every week we're talking to acquirers who are looking for social first and influencer agencies. However, there's a real scarcity in the market for agencies doing it well and doing it at scale. But we expect to see a few high value, high profile deals done in the next 12 months. Then more generally, we're speaking to businesses who are starting to see signs of recovery after a couple of tough years, meaning potential valuations are getting closer to seller expectations. That, paired with lots of private equity money still being deployed in the media sector, means we expect to see deal numbers increasing in the next 12 months. So that's all from me, and back to you, Esther.
Thank you very much, George. So I'm now delighted to introduce our panel. So Adrian, Indre, Frazer and Paul, if you want to switch your cameras on. So Adrian Talbot is the CFO of Miroma Group, the marketing services group. And prior to this, he worked at Hotwire during its expansion into the US and was commercial director at BBH London and was also CFO of Instinctive Partners and saw them through their sale to private equity, which is one of the first agencies to do that actually back in 2011. Indre Edge is an investment director at Sovereign. She's been at the fund for over 5 years and covers the media and creative economy, helping businesses to grow and navigate change. And prior to Sovereign, Indre was a sell-side M&A advisor. Frazer Bars, he's head of media for Barclays at the large corporate division. He leads a team working with some of the UK's largest, and he says most exciting media businesses across content, video games, publishing and marketing services. And last but not least, Paul Winterflood, who is at one of our more Kingston Smith partners, and he leads our media corporate finance team. And notable transactions that Paul has been involved in and advised on include the sale of Total Media to Service Plan, 23 Red to Capgemini, and Wuxi to Keyword Studios. So kicking off with a question for you, Paul, I guess it would be really useful if you could just sort of give an overview, general overview of how the media sector is faring at the moment in the current economic climate.
Absolutely. And yeah, good morning, everyone. So I think the headline is, look, it's really tough out there. But I think the good news is we are starting to see signs of recovery, but it is a really, really mixed picture out there. Anecdotally, at least, certainly we've had probably since May time, there's definitely been noticeable improvement. There's been more positive calls and meetings we're having with clients, but that's definitely not uniform. We run an outlook survey every 6 months as a practice, which takes the temperature of the media sector and asks people to report how they're performing financially. And we're about to release one shortly, so please fill it out if you can. So We ran one last October for the expectations for 2025, and expectations, as you would expect, then were quite low entering this year, and a revenue growth forecast of less than 5% is pretty poor in the grand context of things. We reran the survey again in April, and we did see some improvement across all the metrics. So revenue growth, headcount growth, as well as margin, and the revenue growth ticked up to 6%. We're rerunning it again this month. Hopefully, we'll see a further improvement for the expectation for 25, and then into 26. But we'll have to wait and see what that actually is the case or not. I guess the area where we see actual published results is, of course, with the listed groups. The listed groups have reported their H1 numbers effectively, and again, that's a real mixed bag. So Publicis reporting organic growth of north of 10%, WPP a net contraction of I think 3 or 4%. So again, a real mixed picture there. Some performing well, others struggling. I think that's the headlines from what we're seeing anyway.
Thanks, Paul. And Adrian and Frazer, what about you? How are your clients and sort of portfolio companies finding things?
Shall I go first? Good morning, everybody. I think despite the global uncertainty, there are, for us, there are always clients who continue to buy media. George has called it the sort of hot sector there on his thing. I'm not sure I'd use hot, but it's just clients prioritizing that in a different way, whether they're looking at their marketing budget and cutting it towards outdoor or digital. And in some of our fast-moving markets, such as literally theatre ticket sales, you can have digital spend coming quickly in to support productions or the marketplace. So I think it's more a mixed picture depending on which part of the market you're involved in.
What about you, Frazer?
Yeah, Paul touched on the listed names, right? And most of those are clients of ours in some way, shape, or form. And I think broadly speaking, it's been quite disappointing for the UK-based names. I think the year started with some optimism for clients that 2025 was going to be a better year. And in Q1, we had some good news on inflation. It was tracking down. It had kind of come down to about 3%. And we thought that trend was going to continue. And then Donald Trump stepped in and mixed things up a little bit. All in all, I think it's been a disappointing year for most of our larger clients who can't help be kind of pulled by the tide when it comes to macroeconomics. If you've got half the FTSE 100 on your books, you kind of can't help but have a relatively poor year this year. But where we've got smaller, mid-sized clients who are doing something a bit more innovative and exciting, it's not that difficult for them to grow. You win a handful of new clients with a new product or solution, and you can deliver double-digit growth. So it's not all doom and gloom.
No. One of the questions that's come in is how are independent agencies faring versus the networks? My takeout is it depends. Some networks are doing better than others. Some are certainly doing a lot worse, and some independents are doing better than others. It depends on a case-by-case basis. But maybe the panelists give your context on that.
I would just say, Esther, irrespective of whether they're independent or listed, if they're driven by pure media spend, it's really hard, right? I think GDP was up by about 1% in the first half of this year, so it's hard for advertising to beat inflation then, which is higher than 1%. Yeah. So if you just tied to that, then it's difficult. But I think, as you've touched on, it depends on what you do, and if you're bringing things to your client that drive efficiency and maybe cost savings or better ROI for them, then they're going to be interested in spending money.
I think the other.
And I think it's okay.
Sorry, go on, Adrian.
No, I think it just to echo that, then it just depends. Frazer's point about the independent and it's the sector you're exposed to. We've got some subsidiaries that are supporting tech startups, and in particular markets where they're going to spend anyway because they're fast growing and they're trying to move forward. So it really depends, quite sector specific, I would say.
What I was going to add to that was one of the themes that came out of Cannes was the opportunity independents have in particular at the moment, because there's clearly is a lot of disruption, a lot of change, one of the advantages of being smaller is you can be more nimble and agile in a changing environment. And for strong independent agencies that have got a really good value proposition, that are targeting the right types of client with the right capabilities, there's a huge amount of opportunity.
Yeah, absolutely. I mean, Indre, you see a sort of a bit of a broader spectrum of the economy. What would you sort of comment? Is that the same across the different verticals and different geographies?
Yeah, I think definitely probably the sentiments echoed across the different sectors and markets. I mean, at Sovereign would predominantly focus on sort of B2B services, so kind of, I guess, very akin to where the media sector sits. And whilst I think the picture is slightly different and varied by different areas and markets, but I think predominant message we're getting from our portfolio companies and the businesses we speak to, I mean, the revenue growth has been really tough. Clients been sort of delaying spend where they can, optimizing their service providers, consolidating where they possibly can to sort of, I guess, optimize their own financial performance. Equally, inflationary pressure on costs, and as well sort of the budget changes impacting the UK. We've seen a lot of sort of cost increases coming from that. I mean, looking at specific sectors, probably, where there is a bit more essential services, so like, healthcare, education, the demand continued. And I think a lot of the impact was seen mainly through the cost increases, given the sort of lower cost base. Then I think technology services has been quite varied. A lot of sort of, again, depends on the subsectors you're in. If you're in sort of cybersecurity or very much in the digital transformation, to echo what Frazer was saying, if you're sort of helping your clients to optimize your operations and save costs, then I think you kind of probably saw a good demand there. Financial services, again, very varied picture. A lot of our portfolios were dependent on the stock markets and AUM growth, so that was quite challenging in the beginning of the year. So I think it's varied, but none of our portfolios or businesses we talked to were saying it's a sort of a great place to be, and macroeconomic is it's wonderful. So yes, it's definitely tough out there.
Yeah, I think that's definitely the theme coming through. I mean, Adrian, Miroma sits across a number of different disciplines, isn't it? And you mentioned those supporting the sort of the tech, high growth tech, maybe finding it a little bit easier, but generally what sort of disciplines are the ones that are perhaps doing better than others?
Well, we found the sports and entertainment market fairly resilient. I mean, again, George had it on his hot segment. And I mean, I think that is, we've got a strong market presence in the West End and Broadway in sort of theatre advertising and so the consumer, and then also a division on concert sales. So, if you witness the Coldplay and Oasis tours, ticket prices, the consumer is still spending in that area. And so George also moved on to the sport. And we've got a joint venture with Gary Neville in a podcast called The Overlap, which is doing really well at that point on content and interest to the online audiences. And so and another factor for us is outdoor advertising, which is still, despite the move online, is still a strong area, just because of, if you witnessed recently if you saw the Lime Bike outdoor campaign during the recent underground strike, good service on all limes. Look at the Tesco campaign with the women's tournaments. British Airways said this week, they got 98% brand awareness from outdoor. So that part of the market, when you can strategically put an ad at the roundabout on the M4 and capture people's attention, is still not talked about so much, but is a good resilient part of the market. So those sectors for us, where the consumer is still spending on experience, the outdoor market, and the online sort of podcast area, are all quite interesting.
I mean, last year, 2024, was particularly challenging, wasn't it, in terms of clients actually parting with their money, even when they'd sort of agreed projects. Are you seeing sort of general improvements with that through the course of 25?
I think it's early to say. I mean, I think I repeat the sort of segments I've talked about where it's been fairly resilient, and our portfolio is pretty diversified, and we've got growing presence in the US, and we've got a strong presence in Asia. So those are big clients who have annual budgets, who commit and want to go ahead anyway. So you might get some phasing in that, or you might get a decision point on the budget cycle. But as I said earlier, clients are still buying media and still focused on markets like outdoor.
Frazer, what are your clients experiencing?
I think this point about decision making is a real pain point for a lot of our clients. Not necessarily decision making actually, but just the time to then follow up on those decisions. So we've had lots of clients this year where they've won some huge contracts in Q1. You could be with P&G, Unilever, somebody like that, and everybody's kind of high-fiving and slapping each other on the backs. And then fast forward to September, October, and the thing's still not really gotten going. And I think that's frustrating a lot of our clients. Is they're not losing, they haven't lost business, but the businesses they have got are slowing down, and then the new business they are winning is taking painfully long to actually come online. And just to my point earlier about, if you're delivering efficiencies, cost savings, or improved ROI for your clients, then you stand a better chance of winning business. Even that business just seems to be taking way too long to come online. And I think it's just a feature of these big businesses. I work in one of these big businesses, right? And Barclays can be like an oil tanker sometimes when you're trying to change direction and do something different. So I can sympathize to a certain extent, but from what I'm hearing from clients, it seems to be even worse this year in terms of just, right, we've agreed we're going to do this. How long is it going to take you to disseminate that down into your teams and actually start it up? And the revenue just comes through so slowly. So I think I take a bit of heart from the fact that the clients we're talking to aren't necessarily losing business or not winning new business. It's just all painfully slow at the minute. And I think this build up to the budget, which I'm sure we'll touch on at some point, is not helping that.
One of the delegates just pointed out when they said, good point, Frazer, about what you said, it just makes planning really, really difficult because a lot of things are so short term. So planning ahead for your staff and resource needs is just really, really difficult. I'm sure you've perennial challenges, Adrian, within agencies, but I'm sure you're finding that particularly difficult at the moment as well. What about the borrowing landscape? Frazer, are you seeing any sort of changes in that in terms of whether it's for sort of positive reasons of investment or sort of defensive reasons to shore up cash flows?
Yeah, it's not, we're not lending really for defensive reasons. I haven't lent anybody any money recently to dig them out of a hole or because, their working capital was drying up. We do support people with working capital, but it's not a massively increasing theme where people are struggling with that. So where people are borrowing, it's for positive reasons, but I do think clients are definitely more cautious. I think what we're seeing from trade buyers and businesses in this sector making acquisitions is they're typically looking for smaller bolt-ons, some new capability or geography that they can just see is definitely going to work out for them. They're not taking huge risks. We're not seeing businesses make big transformational acquisitions and massively scaling up in the current market, probably because the sellers don't want to sell unless they're getting the multiple that they want, and these guys don't want to pay either. I think one exception to that, where we are seeing some bigger transactions being looked at, and I'd be interested to hear what Indre thinks to this, but we are seeing some private equity-owned businesses where the PE house maybe bought them in 2021, 22, when there was a bit of a bubble and things were going pretty nuts on multiples, and they haven't really got the exit that they might want 3 years, 4 years down the line. So they're exploring different options, and we are looking at some decent sized businesses looking at mergers and saying, is there a bit of arbitrage here if we bring two good sized businesses together? And maybe that gets the private equity houses comfortable to stay in for a little bit longer because they can see where the wind's going to come from in the end.
Indre, what are your thoughts on that then, sort of from a PE perspective? Are you seeing more people sort of looking to sell or in a position, in a sort of positive position where they might be able to sell their agencies? Has that sort of changed much over the last year or so?
I think definitely seeing an improvement in the last sort of couple of quarters. I think Paul referenced to that, sort of seeing the momentum increasing, and it's definitely visible in terms of the conversations we're having with the sort of vendors looking to sell. I mean, PE interest in the sector has sort of never went away, to be honest, even over the challenging periods. I mean, we're still looking to deploy capital, and I think to an extent, it's kind of a little bit more even, I would say, pent up. I mean, lack of deals and sort of delayed transactions actually means that we actually even more need to deploy and want to invest in good assets. So it's actually quite positive to see that momentum slightly pick up. I feel like to an extent it's a little bit driven probably by the budget timing. There are a few, if you are having a few conversations early in the year, I think people are sort of, if they're seeing improvement in their trading, we're definitely sort of now hearing sort of which we're keen to do the deal by the budget. So obviously, again, from PE perspective, we're very happy with to see that momentum and seeing it as a sort of a positive change. So I do feel that there will be a little bit more an increase in deals, especially in specific areas. I mean, I definitely sort of from our perspective can relate to some of the sort of slides that George was presenting earlier, seeing sort of quite good activity in sort of PR and strategic comm space, equally sort of creator economy, definitely again sort of one that I think is quite nascent probably for private equity, but it's starting to look quite attractive from the various considering various fundamentals there. So yeah, I feel quite sort of probably positive towards the next year and seeing an improvement in deals.
Is that reflective of what you're seeing across the M&A market, Paul?
Yeah, definitely. I can see all of those trends. So from the point that Frazer was making about PE taking longer to exit, particularly that probably the vintage of sort of 21 and 22 would be thinking about exiting by now. We know some of the PE exits that have happened have taken a bit longer than I think people were expecting, but they are happening. In terms of what's driving bolt-on activity, the fundamental driver is that certainly over the last 12 months, businesses as a whole, or agencies as a whole, probably weren't performing well enough to meet and to support the valuation aspirations of sellers, which means there's less opportunities for acquirers, of which there's many. It's a highly fragmented market due to the number of private equity houses at play. On top of that, we've also got the volatility in trading means that deals are taking longer. Acquirers and investors are taking longer to get comfortable with the numbers, and particularly if there's clearly valuation expectations that need to make, that just stretches things out, which means that completions are whilst happening are taking longer to come through. We have definitely seen an uptick in activity over the summer, particularly I'd say in off-market approaches. We're aware of a number of PE deals and PE-backed deals that are ongoing at the moment. So for the right business that's got valuation aspirations which match to their trading and market multiples, there definitely are deals to be done. There's so many well-funded acquirers out there. Private equity dominate the landscape. Like the majority of deals in this space are either private equity direct or private equity backed. So a private equity bolt-on. I think we're reporting 55% this quarter had PE involvement. That has certainly been the case for the last 4 or 5 years in this sector. It's a trend we talked about, and that trend is definitely not going away. There's new private equity houses coming into this space all the time. There's a highly dynamic opportunity for people to for people looking to transact.
And what sort of particular capabilities are you seeing demand for? We've talked about some already, but are there any other ones?
I'd say the George outlined the key ones. So social first agencies, they're in really, really high demand. I think the social spend is increasing all the time. You've got the interaction with the creator economy, influencer agencies. I think are looking to expand their capabilities beyond just influencer into broader social. So that is a really strong area. Stratcoms, as we said, I think acquirers in particular, one of the great things about Stratcoms is the certainty of revenue streams. You often see 60, 70, 80% retainers, which for the sector is pretty rare in 2020, 2025. And then also the strategic relationships that they open up. Like one of the things we did debate about, and like what the impact of AI is going to have is, and I think we've seen that in the polarization of financial performance of agencies in particular, is those that are performing well typically have strategic relationships with the C-suite. A commoditized offering is going to be harder and harder to make money with. So Stratcoms AI is an appealing one, an appealing capability for many reasons. And then experiential in-person events, and just the way the universes and ecosystems are being created around it, whether it's a concert supported by a lot of social media content, so supported by brand partnerships and sponsorships and opportunities for brands to actually get in front of consumers. So a lot of interacting ecosystems in that space in particular.
Now, Adrian, what about in your position as a sort of potential acquirer or investor? Are you seeing more sort of deal opportunities come across the table, and what's the quality of those like?
I mean, I think Miroma's got a long history in backing businesses at sort of all sorts of stages, from startup to backing founders looking for their next stage of growth. So there's always a steady stream of things coming to us, and that, you know, will hopefully continue. In terms of what it means, I mean, I think it's just more at the moment, if you're looking at anything where you might, you know, take a haircut on somebody's numbers, you might be looking at that in this climate of uncertainty, thinking how safe are those earnings, or you see a lot more adjustments perhaps. I guess it's just that uncertainty point, but it's not. I still get emails every day of potential things, and there's certainly a volume. I think it's just everybody's just so cautious that it makes it just, as Frazer said, just slower to do everything.
Are you seeing any sort of trends in any particular capabilities coming across your desk?
No, I mean, George had the, you know, performance and media buying is the sort of hot sector. That would be where we'd sort of probably focus first. But not particularly. I mean, I think all the things that were on the list are consistent with what we see. It's just some of them we'd be more or less interested in.
Yeah. And in Indre, I mean, when you're looking at the media sector, and in particular the marketing services sector, what is it that's sort of attractive about it from an investor's perspective? What are you looking for?
I think, to be honest, I'll probably pick this up as more generic themes. I think from a PE perspective, because we look at so many different businesses and so many different sectors, I think we kind of probably pin down the sort of focus on key fundamentals, which are important, and I think underpin the successful investment for us. So it's probably sort of the three key points is that recurring revenue profile, strong management team, and then I think lastly, sort of having that differentiated proposition. And I guess just diving into these specifics from recurring revenue perspective, it doesn't have to be contracted. I mean, Paul referenced obviously having retainer revenue, that's great. I mean, music to PE investor ears, but equally, I think just demonstrating that you've got that relationship with your client, long-term repeat spend. It's, you know, that is what that basically underpins, you know, your sort of resilience in the markets where it's becoming challenging. Again, management team, I mean, there's obviously different kind of PE investors in Sovereign. We predominantly back the team, so we don't run the business. So having this depth and strength and, you know, proven management team is very, very critical for us. And that goes down to even the second tier management team, because I mean, obviously you've got your C-suite, but it's just having that also support and the strength underneath is also particularly important. And then it's a differentiated proposition, and that can be anything. I mean, it's just the ability to sort of differentiate yourself outside of your competitor set. What makes it different, whether that's your, you know, different services, whether it's a delivery model, maybe it's a technical capability, that could be something, you know, it's unique to every single business. And actually, last, I know I said three, but now it came to my mind, the second, the fourth one, exactly, the fourth one. I think from Sovereign's perspective, the reason we are very much attracted to media and marketing services as a sector is the buy and build opportunity. So the sort of the ability, the consolidation in the space, and you know, having a business that actually is interested in pursuing that strategy and having done some acquisitions in the past is very attractive to us as well. So that's probably, yeah, the key four things.
And how do you support agencies through that buy and build strategy? And what are the sort of essential ingredients that make some more successful than others?
I think, I mean, it's so I guess at Sovereign we're very, very experienced in buy and build strategy. So we've been doing this for 20 years. And I think the key three things that probably underpin, in my mind, the successful buy and build strategy. And obviously there are many other aspects you need to consider. There's a lot of things, but if I had to pick the top three, it's having the strategy of what you're actually trying to create. I mean, but just chasing revenue and scale is never a good idea, because at the end you probably end up with sort of something that, you know, in the end it doesn't have a coherent strategy, it doesn't integrate well. So that having that sort of end goal in mind, I think, is really important. And it just sort of, you know, makes it easier then to define what you're looking for, etc. Secondly, I think having not forgetting, I guess, when you're looking for acquisitions, paying attention to cultural fit of the actual businesses. Two acquisitions might look amazing on paper in terms of strategic fit, and it makes absolute sense. But if you know you don't have a team that fit together really well, culture doesn't work. It never works out well. And in the businesses where you're relying on people, that is fundamental in my view. And then last, I think, having sort of coming probably more from Sovereign's perspective, because we have a very strong origination team, as we call it, we think that having optionality in transactions is really, really important. So our origination team would spend a lot of time mapping the market and producing long lists, giving the businesses sort of opportunity to choose from, you know, what is the best sort of strategic fit and cultural fit acquisition. So you're not sort of pigeonholed on doing one deal, and you have that option to actually, you know, choose the best one. So that's probably our sort of I'd say my sort of top three.
Yeah, makes sense. And Frazer, how do you go about supporting your clients making their acquisitions?
Well, I guess we lend them money is the obvious one, isn't it? But I think just to elaborate on that a little bit, we try to get on the front foot. So, you know, I think it's a mistake to go out deciding who and what you want to buy before you've had any sort of conversation with your lender about what the art of the possible is. And, you know, it's like going to buy a house, right? It's always better if you've got an agreement in principle behind you from a mortgage lender. And so we're always happy to have really early stage theoretical conversations with our clients or even non-clients about what they might be able to access from a bank. And I think importantly, we're open and honest about what we can and can't do. So, you know, if you're just not quite there yet and you don't quite tick the boxes for us, we'll tell you, and we'll try to tell you who we think you might tick the boxes for. And sometimes it's not Barclays. It might just be that it's not going to be a term loan or a revolving credit facility. You know, we're going to have to do something more structured. If you haven't quite hit the scale or level of cash flow generation that we need to give you what is effectively an unsecured term loan, because we're not too keen on personal guarantees, and there aren't many assets within these businesses. So if you're not quite there, we can look at, you know, leveraging things that exist within your balance sheet, looking at your debtors, etc., and seeing if we can maybe either use that to fund acquisitions or maybe just use that to solve the working capital question for you, so you can use what cash you do have to go and splash on growth. And yeah, look, somebody, I spotted a question, Esther, aimed at my point about mergers and saying we don't see many of those, do we? And can I expand on it? So we're not the ones broking them. To answer that question, I think the people who are brokering these merger conversations are the businesses, or at least their shareholders, and they're just having very, very high level, without sharing too much information, conversations with leaders of similar sized businesses and saying, you know, could this make sense? And I can't share any great examples to that question because I don't think much of this has actually happened yet. I just know
No.
some of these conversations are happening. And look, I mean, there's one, right? There's Omnicom IPG is being badged as a merger, but it's a 60-40 split. It's not a merger of equals. And there was a bit in the press about the S4 Capital and MSQ partners had a conversation, and that then had cold water poured on it and doesn't appear to be happening. But I think it shows you that these conversations are being had at some level, and you can see why. Because if you can see economies that could be driven between two businesses, why not explore that?
Although I think ultimately some of these will be takeovers rather than, like you say, rather than true mergers.
I can't think of any 50-50
No,
split,
it's quite
but
rare.
they can be harmonious.
Paul, what's going on from a valuation and a deal structuring perspective? Because obviously that helps inform when exploring with Frazer what the art of the possible is in terms of how much lending one might need to fund these acquisitions.
So I think the theme that all my points have been making seems to have been around variability and probably a real mixed picture, and that's varying from capability to capability, business to business. A business that's growing, that's got a sought after capability, particularly in the marketing services space, if anything, valuations are going up at the moment because of scarcity. Like there's a huge proliferation of acquirers who need to and want to do deals to generate growth. If you've got a capability which appeals to a number of different buyers, you're likely to be in an auction situation if your proposition is right. On the flip side, if you're a seller with a business that's needing to sell off a weak footing, poor financials, risk factors, clearly the opposite is true. If the business is even sellable at all, unfortunately. What we're definitely seeing at the moment is acquirers looking to manage risk through deals in a more volatile environment. So if the business doesn't fit into either of those two camps, is maybe and there's a deal that's wanting to be done, we have seen if there are risk factors, if there is, say, a client concentration, we've seen valuations holding up, but we've seen that risk being managed through the deal structure. So there's definitely been some deals we saw earlier in the year, the bolt-ons where there was sort of 20 to 30% being paid upfront. I would still say that the average deal is 50% upfront, a 3-year earn-out. The huge number of different buyers in the market means what that actually looks like does vary substantially, but that's still that is still, I'd say, the average deal for a independent business or agency looking to sell.
What about the forthcoming budget? Obviously, there's a lot of noise about what may or may not happen in there. How do you think that might impact the M&A market?
So our tax colleagues are probably getting very nervous, me being asked a tax question. So you'd be pleased to have got some pre-prepared points that have been approved by them. So so they say
House view rather than Paul's view.
yeah. I can give my M&A take at the end. So firstly, business asset disposal relief is increasing from 14 to 18% from the 5th of April 2026. Yeah. So if you've got a deal which is already progressing, have that in mind. There are things you can do if you think if you're getting close to the end of a deal, such as a unconditional exchange, which is the tax point, be the 6th of April, but that's the first date to bear in mind. As with all, the second one is then post April 26, business property relief is being reduced. That's relief from inheritance tax. At the moment, shares in a trading company qualify in full for IHT relief. Post April 26, only the first million. So there might be opportunities to plan so people are wanting to hold shares for the longer term, and there may be increased M&A activity where potentially somebody has sadly passed away and the beneficiaries of the estate need to sell the business. And then thirdly is then the general taxes. So the Chancellor's previously said she won't be raising income tax, national insurance, or VAT, but has got potential to raise the thresholds again. So that may become an increased cost to individuals. And she also hasn't ruled out business tax increases. Clearly, we saw that increase last year. And obviously, for people-led businesses, that was extremely costly. And so I think we obviously, everyone hopes that isn't repeated. So in terms of what that means for an M&A market, the first two always it won't have a significant impact, I don't think, for strategic M&A opportunities. But they certainly, that timing point and that deadline is often helpful with deals. You always see if you've got a deal which is getting close to completion now, discuss with your advisor, because it may be worth trying to get that pushed through before the budget. There's always pros and cons, but that's certainly something to consider. And then again at the end of March. So I think we'll see a swell of transactions at those two dates. The final area, I think we're all hoping that the budget doesn't cause further pain for businesses. I think Fraser's already alluded to the challenge and that the uncertainty is causing, and I think that just remains that's clearly all in the balance. We probably won't know until until budget day what that actually looks like. But it's not been a great environment, right, for the last 12 months. Great businesses there's still opportunities for great businesses to transact, and there's still M&A activity. Is probably the final point to make on that.
And Adrian, is a potential acquirer, is it sort of shaped your thinking at all?
I mean, I think, to echo Paul, it's not so much the budget itself, but I think we've now had 2 years where we've been sitting for 3 or 4 months wondering, what will she do, what won't she do? And to some extent, it's created this very strange climate that I don't recall across my career. And in some extent, I wish I'd just have the budget tomorrow and get it out of the way.
Yes.
It just because I think it's not so much. It doesn't stop us sticking to our core strategy and what we're trying to do, but it does just make everybody think, hang on, Paul's just highlighted some tax implications. You've just got, I think there's probably far more variables on the table and more uncertainty, which just impacts everybody. And that, I think all you can do is just stick to your core strategy and then just see what happens. There's not much you can do about it.
Anything to add to that from you, Fraser or Indre, from a banking or PE perspective?
I think I sort of echo Adrian's comments very much. It's just feels like it's causing very, very much of an uncertainty, which is not good for any buyer or seller in the market, and it's quite sort of difficult to predict. I think, as I said, from what we're seeing, there's a little bit of this pre-budget rush now. I think that sort of the businesses that came to decision that they're willing, sort of shareholders are willing, want to transact and looking for a PE partner, they're quite keen to sort of, I guess, do that before the budget. And so we're seeing a little bit of that. But yeah, it's just overall uncertainty is definitely not great for just in general for the sentiment.
Yeah, I agree with Adrian. I wish we could just have it tomorrow. I think the last one, actually, it wasn't that bad, right? Like, I think once it happened, it was like, I wasn't so bad. Let's just get on with everything that we said we were going to do now. So I'm just very keen and hoping that it's a similar story that we get. And I think there's a lot of negativity in the build up to it. So I'm hoping that when we get there, that actually is a little sigh of relief, as I think there was last time around, and then we can all get back to doing what we want to do.
Let's hope so. Let's hope so. So looking forward then to 2026, what's the outlook for the sort of the M&A market more broadly? Maybe sticking with you for the minute, Fraser.
Yeah, from a bank perspective, appetite to lend is unchanged. One thing I'm quite proud of working at Barclays is we've been super consistent in our approach to lending in this space for the last 5 or 6 years. I'm thinking back to COVID, we didn't turn the taps off. And we've been really consistent in our approach. If anything, in the last 12 months, our appetite to lend has gone up, not because this industry is going kaboom, but because Barclays and a lot of our competitors as well are just really trying to grow our balance sheets. If you go and open up the annual results or any lender or any investor presentation from any major UK bank this year, there's so much focus from analysts on, are we growing the amount of money that we are lending to UK businesses to help drive this economy. And that pressure filters down to me and my team to try and get out there and find people to lend money to. So the books aren't closed. We still want to lend money. And I think that applies. I don't want to kind of do their jobs for them, but I think that applies to our competitors as well. So, you know, in terms of the outlook, you know, if the appetite is there and there are acquisitions that make sense, you can afford to pay it back, you know, a bank's going to lend you the money to do that. So we won't be a blocker to it.
Indre, from a PE perspective?
Very similar story as Frazer in a sense. We were, well, as reference, given the sort of lower transaction volumes, we definitely have more capital than ever to deploy and very attracted to this media sector in particular. So, and we think there's plenty of opportunity. So we're always open to speaking to vendors and sort of trying to get the deals done, and equally very sort of accommodative of, you know, accelerated timelines if needed, and being creative with deal structures where we can. So definitely very, you know, appetite has not changed, and as I say, probably stronger than ever.
Adrian?
I think the markets has plenty of opportunity for us. We're in some of the, you know, hot sectors, as George said, and you know, I just want Rachel to do the budget tomorrow and Fraser to lend me more money and we get on with it.
We'll be fine. And Paul, last but not least?
I'd say cautiously optimistic. We've definitely seen improvements from the M&A market. Acquirers are numerous and well-funded, so would definitely see transactions being completed. Hopefully, if that trading continues to improve incrementally and the budget's okay, then hopefully 2026 will be a significant improvement on the last couple of years in particular.
We're very near the witching hour. We might just have time for a really quick one top tip from each of you. So, top tip for media businesses considering a transaction. Staying with you, Paul.
Top tip is plan early. 2 to 3 years out is when you really need to be thinking about it to implement any changes.
Yeah. Indre?
I'm not going to take Paul's job away because he's the M&A advisor. So, but I think from the investor perspective, I will encourage early conversations. I mean, meet the potential buyers as early as you can. Build those relationships. I can't stress what a difference it makes through due diligence process, all the way to, you know, the end exit.
Frazer?
We've gone a whole hour without talking about AI, which is amazing. So I'm just going to throw it in there just to tick that box. My top tip would be to be super well versed on what it means to your business. You know, if you're wanting to borrow money, then we're going to want to know, are you at the pointy end of this? You know, are you kind of at the cutting edge, and is that going to drive you forward? And acquirers will want to know that as well. I saw a terrifying stat about what percentage of VC money now goes to AI related businesses. It's basically all of it. So that kind of tells you how important it is. But also, can you convince a bank that AI isn't going to wipe your business out? You need to be well versed on why you're still going to exist in 2 years' time.
Yeah. And last but not least, Adrian.
I'm pretty boring. I mean, make sure your core business is on a sound footing before you set off, and it'll take. I agree with Paul on preparation, but also acquisitions just take far more time than you'll ever imagine in terms of management time and that. So you've really got to be really strong on what you're trying to do, identifying your targets, focusing, and yeah, there you go.
Super. Well, it is 11 o'clock. Thank you all very much. Some really super useful insights from the panelists today. And also we'll be sending out our usual sort of summary of tips from across the board. Before we end, a quick plug. We've got our survey coming up in November. We're holding it at BAFTA again, where we'll be presenting the results of our survey, looking into the financial performance of marketing services companies. Invites will be going out for that soon. So hopefully see some of you there. And we'll also be sending out our sort of temperature check outlook survey soon. The more people that complete that, the more useful it is. So please, if it lands on your desk, it really is quite short, not too many difficult questions. So please do answer that if you can. Remember, this was recorded. Do share it with anyone who couldn't make it. And fill out our feedback survey. Like I said, that's super useful for helping us to shape future webinars. So other than that, I think just thank you again to our panelists, and enjoy the rest of your day, everybody. Thank you.
Bye.
Thanks, Esther.
Yeah.
Thanks.